Trivariate's Adam Parker. He is with me here at Post 9. Rather than the sky is falling, okay, let's try and help people understand what they're witnessing, why it's occurring, and the size of the umbrella, if you will, that they might need. A golf umbrella or something smaller? What is your takeaway for, let's say, the last 24 hours from big rally to big sell-off?
The last 3 times that I've been down here, 2 Fridays ago, last Friday and today, the market's been down more than 3% all 3 days. So maybe it's just you and I getting together is a negative quant signal at this point.
Speak for yourself.
Yeah, I don't. When I'm not with you, everything's fine. I mean, I didn't see you yesterday, and it was great. You know,
in all seriousness, though, what's going on?
Look, I think what's going on, if I describe more than the last 24 hours, just building into this, we had a big change in the perception of rates. We had a growth scare. We had a war. And we've had an earnings season now where people are looking for, reasons why maybe the earnings trajectory could be impaired. Are corporate earnings going to hold up? When I take and you know, there's a lot of money running pods, degrossed and grossed up, and we're seeing a degrossing. We're seeing a real fear, take over. But when I take a step back, I'm more bullish now than I was last week because the market's down meaningfully. And I think the earnings look pretty good to me. The consumer looks like it's holding up for most companies that reported. We heard that from all the banks, and we've seen that from a lot of the consumer companies and the major staples. So I'm sort of thinking, what do I think today versus yesterday versus last week? I like the stock market a little bit more, Scott, because prices are down and earnings are okay.
In terms of, before we even get to that, like the mechanics of what is happening and why the selling was so severe today, forced selling, no doubt, right? Margin debt is at extraordinarily high levels.
Options, market gamma, there's some stuff happening.
People are being forced to get out of some positions that they otherwise might not. That could be a role. I'm told by somebody earlier today, within the last hour or so, that a lot of the selling today was primarily driven by $12 to $15 billion in levered ETF flows. Right? Those products where you like triple levered, right? And then when rates shoot up like they did today, and I'm also told that it was primarily related to NASDAQ, right? These triple levered ETFs, the Qs, the TQQQ. You take advantage of it to your advantage on the way up. But when rates shoot up, the environment changes. It's a sell and get out of risk as fast as you can. And that feels like, and I'm told, in fact, from somebody senior, that's what we were witnessing today.
That's what I mean by degrossing. It can happen either from the levered funds or it can happen from, maybe a lot of people don't really appreciate that there's a lot of money being run with a huge gross exposure, meaning, you have a balance sheet of $100 million, but you're running 4 or 5 times that in gross. So there's really $400 or $500 million at that. And so when you trip these kind of risk triggers, we call them, and you get, all of a sudden you have to take the gross down to 200, 100. And so you just get a lot of forced selling, and it's often indiscriminate where higher quality names that are in the queues get sold off at the same rate lower quality does. And then somebody like me comes in and, wait a minute, I'm excited now because I've got real semiconductor companies trading at 15 times earnings that I know are going to be good stocks in an 18, 24, 36-month view. So if you're an investor, I think this last week is going to provide some pretty good entry points in a longer horizon.